just days after the Newtown shooting, Cerberus Capital to sell gunmaker Freedom Group. Let's talk to Reuters correspondent Ernie Scheider. All right, Ernie, after that tragic shooting, Cerberus Capital selling Freedom Group, they make that gun that the shooter used in Newtown.
Yes, they make the Bushmaster AR-15 used by the alleged shooter in the Newtown shootings. Cerberus basically came out and saying, look, we don't want to own Freedom Group anymore. They're putting it on the market. This is a lot of pressure from one of the largest pension funds in the United States to do it. So definitely a big movement today, affecting shares of gun makers and bullet makers as well.
Right, pressure from Eliot Spitzer, who came out with a statement directly aimed at Cerberus. Of course, we've heard Mayor Bloomberg come out. So from all sides. And the Wall Street Journal pointing out, actually, which is interesting, that Stephen Feinberg, who was one of the founders of Cerberus, is an avid shooter and hunter himself. George Kalidas, who was a former managing director and CEO of Freedom Group, unsuccessfully ran for a board seat on the NRA.
Yeah, a lot of connections there. What I can tell you, though, I was out in Newtown on Saturday reporting out this tragedy for Reuters, and just the sense of grief is, of course, palpable there, but also the sense that something needs to be done now on gun laws and also to increase gun restrictions and on ownership. And so I think what you see today with Cerberus is the start of a tide, and you're starting to see other companies come out as well. Walmart, Cabela's, Dick's Sporting Goods, limiting the amount of guns that are sold in their stores, some taking tighter restrictions. So I think the Cerberus is kind of the first of what we'll see as many movements by companies.
Right. Sensing that perhaps there'll be tighter restrictions in place, and you mentioned Dick's Sporting Goods taking guns off the shelves near Newtown, which obviously no surprise there. Okay, Ernie, stay put, and we're going to come back and talk to you later in the show. But for now, I'm going to move back to the Market Monitor and talk to Jennifer Saba. We're going to go a lot lighter here. We're going to talk about TV and radio ratings. Nielsen, a broad marketing company, but we know them for TV ratings. Arbitron radio ratings coming together.
Yep. They announced a deal this morning, $1.3 billion. Basically, Nielsen's going to buy Arbitron, and Nielsen is the dominant TV ratings guy, and Arbitron does it in radio, and so basically it's going to create a powerhouse.
Right, which is all important for advertisers.
Yeah.
But also, both companies, I think the challenge right now is where to find those eyes and ears that are on the multitude of platforms out there, streaming, in your car,
absolutely.
online, anywhere.
And they're all
mobile.
saying, Nielsen and Arbitron are basically, this morning they're saying, like, we're kind of all over the place. We're trying to capture where people are and what they're talking about because, like yesterday, for example, Nielsen announced a deal with Twitter. And so they're just trying to get, like, the buzz of, like, what advertisers want to hear and, like, what, brands people are interested in.
They want to capture the chatter on Twitter about certain shows. Doesn't necessarily mean that the ratings for those shows are higher, but perhaps the engagement or the passion for those shows, which is something that advertisers also really like.
Yeah, they're very hungry for that kind of information and kind of what to do with it, and so they can make a case that, hey, everybody's talking about our product on Twitter, and this is we need to be on there, and how do we do that? So that's one of the big things that everybody's looking at right now.
So the two TV and radio ratings joining forces will be able to help each other out in that regard. Okay, Jennifer, thank you so much.
Thank you
for filling us in there. And now I'm going to move to guest number 3, Anthony Curry, Reuters Breaking Views columnist, and we are going to talk about Meredith Whitney. There she is. She's right behind you, man. She's looking over your shoulder.
Stab me in the back.
Long, of course, bearish on the banks, going bullish now. She's upgrading B of A, Discover, Citi, and saying that the January stress test is really going to boost stocks here.
Well, I mean, that may well be true, but let's turn it around. If you are strictly adhering to Meredith's calls, then you would have missed out on one of the biggest bull runs in 2 of the banks you mentioned. Citigroup's up 50% so far this year, and B of A has doubled this year. So all that means basically is as good a work as she can do sometimes, she's just a stock analyst, and stock analysts are not very good at making calls on when stocks go up and down. So if you want to follow recommendations, fine, but you have missed out on the best run-up in these banks in a while.
All right, well, let's just flesh this out a little bit. She's saying basically that more money is going to go back to shareholders, right, through dividends, and that perhaps B of A will quadruple its dividend?
Yeah, I mean, it's possible. Now, the stress test, don't forget, this year was quite controversial. Citigroup had its plans to return capital completely rejected. No one could really quite work out why. Other banks are saying we're not really sure we can work out how they came up with some of these numbers. So this year it should be a bit better. But But if you look at the really sort of bad stress scenario that the Fed's coming up with, it's so bad that some banks are saying that we're basically expecting that the Fed's going to tell us no to returning a great deal of capital. Now, B of A, as you said, Meredith's saying that they may be able to return, or was it quadruple their dividend?
Right.
I mean, its dividend's so small, it's almost irrelevant, and that shouldn't push the stock price up a huge amount, even if it quadruples. So, color me rather skeptical, as you can probably tell. I mean, she's right. The stress tests, they're a really good idea, the stress tests, as long as they're done properly, and hopefully this one will be better run and better understood. But there's no real reason to believe that suddenly banks next year will return a great deal of capital. And earnings still are pretty measly. Jeffrey's results today, record revenues at the investment bank, but returns are still pretty low. So there's nothing really great to get excited about, unless the Fed surprises us.
Okay. But, you know, she still may be the only analyst who has a former professional wrestler as a husband.
Well, of course, that does count for a great deal, and I'm sure that's why a lot of people are buying her products.
Okay, Anthony, great. Thank you so much.
Sure.
I'm going to go back to the hotspot, and as I do, remember, check out our snaps at the bottom of the screen for more headlines of the day. Hello, Ernie. Nice to see you again. Thank you for hanging in with us. We're going to talk about buybacks because today's news, Coca-Cola Enterprises, bottler mainly overseas, authorizing $1.5 billion share buyback program. Big story in the Wall Street Journal about buybacks. Some companies, GE, United Technologies, Boeing, all have big buyback plans ahead. Give us some of the psychology, the background to this right now.
Basically, if you've got a lot of money and you don't know where to spend it because you're not sure where the economy is going, spend it on yourself. And a lot of companies are finding with their huge cash stockpiles right now and what they consider depressed stock levels, they're going to invest it in themselves. So you see the GEs, United Techs, as you say, the Boeings, all buying back a lot of their stock out there right now. It's, you know, we're talking about the fiscal cliff a lot, and companies are saying, some companies are giving out dividends early. So, you know, why would you do a buyback? Well, I was talking to DuPont CEO Ellen Kullman last week because she had just announced a $1 billion buyback, and she was saying she feels like the buybacks better serve her shareholders by reducing the share count. And I think that's the key right now, reducing the share count, because by reducing your share count, you increase your earnings per share next year.
Right.
So that makes results look a little bit better, makes everyone a little happier, you know, warm, friendly, fuzzy, blah, blah, blah. So I think that's part of the psychology here as well.
And you're also getting interest rates lower on borrowed money for buying back than you necessarily would for paying out a dividend.
Yes. I mean, certainly it depends on the company and the industry, but broadly that is the rule.
But you're not growing the business per se.
No.
With that money that you've got on hand.
But we've already got a lot of companies cutting CapEx next year, not sure if they're going to be hiring, not sure what the fiscal cliff is going to lead to. So if they're not even planning to grow to begin with, and they've got all this cash, it's burning a hole in their pocket, why not put it to use, reducing the share count?
All right, Ernie Scheider, thanks so much. Remember, folks, follow our Twitter feed, @Reuters Insider, and our YouTube channel. A ton of great videos on there, Reuters.com/Reuters TV. I'm Lisa Bernhard. This is Reuters.